Hi folks, thanks for joining us. We have a little talk show that we call Money Talks, and we are here to answer many of your questions about just day-to-day things that come up that a lot of people just don't know where to turn. Well, we've got all the answers here. Our show is called Money Talks, and my guests are from Finer Wealth Management, Michael Finer, Gary Kuhn. Thanks so much for coming.
Great.
It's great to see you guys.
Great to be with you.
There's so many questions. People are completely overwhelmed. So let's just start with the basics. This year, so we're halfway through 2015. What kind of years has it been for investments?
Well, it's been I would say, a slightly up year. Here we are in June of 2015. It's been kind of an up and down year throughout the year, but as we speak, the Dow Jones Industrial Average is up about 1.25 points, so a little bit of an increase.
Better than down.
Better than down, and the S&P is up about 2.5 points. The Nasdaq's done a little better, so stocks have sort of grinded to a little bit of an increase so far this year. Fixed income is a different story. Fixed income is now challenged, and if you've had your money in fixed income, for instance, in a 10-year bond, you actually would have lost money so far in that part of your portfolio. So something to keep an eye on going forward.
What do you think, Mike? Sam?
Yeah, most definitely. The bond market is what's of particular concern this year. The last few months, bonds have lost, 3 to 5% depending on how you're invested. So a lot of people have been surprised by the fact that even though the stock market's been up slightly, that their portfolios have gone down. And that's probably the big theme for the rest of 2015.
We're going to get to that, but first, why? Why did that happen?
Well, the U.S. dollar has been exceptionally strong versus international currencies, and that's really a function of the U.S. economy is much stronger than, say, European or emerging market economies. And the U.S. has been ending its stimulus, where it has been flooding the economy with purchasing bonds and so-called monetary stimulus, while the other economies in Europe have done the opposite. They're starting to flood their economies with currency and provide monetary stimulus. So while we're starting to stop it, other economies are starting to stimulate, and what that's done is caused interest rates to increase. And people see that, I think, every day when they refinance, and mortgage rates have gone up and whatnot.
So the trend, you started to talk about the rest of the year. Is it a trend? I mean, can you predict? Obviously, yeah. Let's hope you could predict so that we'd all know exactly where to put our money. But what do you think?
Well, I think for the last approximately 2 to 3 decades, interest rates have actually been on the decline. And you probably remember 1980 or 79, 80, 81 when interest rates were 18%.
Oh man, right.
And now they're 2%. So in a certain sense, the trend has come to an end simply because things really can't go much lower. So most pundits, and I think the economy seems to indicate that interest rates will be on the rise. So that trend, I think, is something that's here to stay and something that's very serious for anyone who has a portfolio to think about going forward. Exactly how fast interest rates rise or how it happens is obviously difficult to predict, but it does appear that the inflection point has occurred and that interest rates will be going up over time.
Let's talk to people for a moment about their homes, about refinancing their homes, about selling their homes, maybe buying a new home, downsizing. I mean, these are all things that I think people are concerned about when they hear about interest rates. So, I mean, is it a good time to sell your house, Gary?
Well, it definitely is a concern now in terms of being able to, when you go for a mortgage, the interest rates starting to tick up because of the interest rates going up. So hard to say.
All mortgages? I mean, 30-year, 15-year jumbos and home improvement loans?
They are starting to go up. I mean, as Mike said, historically, you look at some of the rates in the past and you can say, well, okay, they're still fairly reasonable, but they are starting to go up. So that may actually stimulate some people in a way to go ahead and move forward. So if you're selling a home, it actually might help from that standpoint, even though they're starting to go up. You know, they're going to say, okay, maybe now's the time to buy a new home.
Buyers
so.
could be motivated by that.
I think it's definitely a topic that they're starting to think about, because home prices are very correlated to interest rates, because people are more concerned with their payment in many ways than they are the actual price of the house. They are concerned about the price, but the payment is very important. It is, and interest rates sort of dipped for 30 years down to 3.5% to 3.75%. Now they're closer to 4% as an example. So you start to feel that in a monthly payment. Like Gary said, it's still very reasonable, but there is definitely a trend where you're probably not quite in the threes anymore and starting to hit 4% and to go that way. So people are, I think, the conversation has started, hey, maybe we better do something, because it looks like interest rates are starting to trend up a little bit.
I mean, and it's not that it's a 0.5 percentage point such a big deal, but I think people hate to feel like they missed out.
Well, it is a good point. When people talk now, they said, hey, I wish we had refinanced at 3.5 or 3.6, 3.7. Now when it's 3.99 or 4%, they feel like they've missed, you know, Kmart special or something. So it is a psychological thing that people want to lock in, even if it's not a gigantic amount of difference.
Yeah. So what are you telling your clients? What are you saying to people about where their money should be at this point and going forward?
We still do believe that this is going to be a good year for the stock market, not necessarily a boom year per se in the positive sense, but we started out the year feeling that this was going to be a sort of a mid to upper 1% single digit increase kind of a year, you know, sort of in the anywhere from the 5 to 10% in terms of the value of stock holdings, and then obviously you have dividend income in addition to that. But and we still think, even though, for instance, the Dow is up, as we said, about 1.25, and the S&P about 2.5, that we still believe that we'll be somewhere in that range, in the mid to high single digits for the year. So we continue to believe that, and there's some reasons for that. One is that we've seen the energy prices, you know, are more affordable for
even
folks.
though they seem to be inching up too.
They're starting to go up too, but it has been we think a benefit to the consumer.
Sure.
To the costs for manufacturers, and I think we just have become now the #1 producers of petroleum and natural gas over the
United
Russia.
States.
Well, that's
so that
for the
just,
first time ever.
Right.
That's
I wouldn't say the
remarkable.
first time. I think the first time in several generations. We were in the 50s and 60s, but then obviously the Middle East and other countries. But I think it was just out this week that we have overtaken Russia, Saudi Arabia, as the #1 producer of hydrocarbons, basically in the world, which is amazing compared to where we were.
It is amazing. I mean, let's take a moment on that.
Yeah, it's been a great
and
benefit.
it affects everything.
It does. I mean, actually, one could argue that the decrease in oil prices is what's been hampering the stock market this year, because don't forget, there are oil companies and other companies that are in the stock market. Yeah. So those companies have actually they're down generally, or they haven't had strength. But overall, obviously, we've had a huge influx of money that's staying in this country, because the frackers, the other oil producers, we don't have to import as much oil from other countries as we used to.
Right, and it makes a huge difference just to people.
And jobs.
Consumers. I mean, yeah, we'll talk about jobs in a minute, but I mean, people are traveling more, they're driving more. I mean, if you ever leave your house, you can't move. The traffic is, I mean, I know there's a lot of reasons for the traffic, and that's an entire other show. But, I mean, it's just, people are more mobile. They're feeling more confident. The consumer price index is, you know, is part of what I think is generating all this well-being among people who are spending money, and it starts with, you know, being able to afford the gas to go to the grocery store.
Right. Absolutely.
Oh, absolutely. And you know, by having that stable inflation that you mentioned, a very, very low 1, 1.5%, it makes consumers more confident that they have a better outlook as to purchasing things. There's no
They're
real
not afraid
Yeah, exactly.
as much.
Exactly.
Yeah. And you mentioned unemployment. It's been down.
Yeah, unemployment is down significantly. In fact, the jobs report came out this morning, and the jobless claims were about the same. And I think last month we created 285,000 jobs. So we created a lot of jobs in the last 4 to 6 years.
I know people always wonder them when those. I know I do when the numbers come out. I mean, does that reflect people who've just given up looking for jobs? I mean, do you feel like that's a really good, strong indication of unemployment in the country?
Definitely not. I mean,
Who wants to take that one?
Yeah.
It all depends on how you look at statistics, right? But you definitely have that factor where people have stopped looking for work. There's no question. But we are adding new jobs that I think is a couple 100,000
And that's a
a
fact.
month.
We're
That's
adding
a
jobs, yeah. Like I said, adjusting it to understand if those jobs are all full-time jobs, if they're good-paying jobs, what part of the economy
I mean,
is adding jobs.
and who are they hiring? That's the other thing.
Right. So, it's like any story, it's a tale of two cities. If you're in the high-tech sector, if you have a lot of skills, if you're whatnot, then jobs are not an issue in this economy.
It's always interesting.
Less
that-
skilled,
I'm sorry.
no, but less skilled is an issue.
It's always interesting to me that number comes out without really reflecting all of the college graduates who are looking for work. I mean, that's got to have an impact on the economy too, right?
Definitely. If you're a college graduate and you have certain types of skills, you have no issue.
And a lot of debt.
Yeah. The amount of debt for college students is over $1 trillion, and that's a huge issue for most students, and it makes a difference on what they pursue and how they deal with it. It's really it can really put them under intense stress.
So what else are we looking for toward the end of the year, the next 6 months? Unemployment, we hope, stays stable. Or
Well, the Federal
continues to
Reserve,
drop?
talking about interest rates, that's something that most people expect that the Federal Reserve is finally going to move off of their sort of zero interest rate policy, and that's been one of the reasons why you've seen, the interest rates of fixed income start to be affected in advance of that. And so most people feel, and I think we would agree, that most likely in the fall, sometime around September, you'll start to see the Federal Reserve, start to uptick on their interest rates. But we don't think it's going to be dramatic and fast. We think they're going to take their time and kind of stair-step their way up over time.
Well,
so.
it would seem silly for them not to do that. I mean, because
Right.
if they a huge increase in interest rates, we're in another. What are we going to call that one? Depression. There's going to be a definite impact on the economy that would not be good. So
And
they're not going to do that.
that's the big question: how they raise interest rates and how little, and how they manage it psychologically. To add some sort of increase this year.
So an increase is inevitable. You think it's
I
inevitable.
think so. I think at least 1/8 of a point to 1/4 of a point is inevitable. Whether that changes mortgage rates and other things, because don't forget, that's just the Federal Reserve rate,
Right.
and that's really a rate that banks loan amongst each other and whatnot, but it's
But
still...
it affects credit
Oh,
cards.
it does, it
and-
does. It affects everything, but they want to. They just can't, because everyone's afraid every time they raise interest rates. The last time they did it, it caused a recession. I hate to use...
I didn't
I
wanna
know,
say
I
the
know you
word.
didn't,
I
I know
tried
you
not to
didn't,
say the word.
but every time they do it, they don't time it well.
Right.
So everyone...
It's not a good time
it's-
for a recession.
It's never a good time for raising interest rates.
Right. And one last thing while we're just on this topic of what to look for in the next 6 months. So what's your advice to consumers at this point about what they should be paying off, what they should be buying, how they should be paying for it? Obviously, now's not the time to run up the credit card bills. Not that it ever is, folks, believe me. But, I mean, what's your advice?
Well, it's definitely to start to, if you can, reduce your debt. Obviously, it's good to reduce your debt
Anyway. Right.
But like you said, the credit card interest rates and other things are tied to various benchmarks, and those benchmarks will be going up, which just means that your interest will be going up when interest rates go up, so it'll just cost you more to have the debt. So to the extent that you can reduce that or refinance now while the rates are good.
Yeah, there was a time, I know that everybody thought that it was a really good idea to take out a second mortgage on your home, or a home improvement loan, or whatever you want to call it, at a low interest rate, and pay off all your debt, because that interest would be less than what you were carrying on the credit cards or the car payment or whatever. Is that still true?
You know, mathematically it's true, definitely, in that it's a lower interest rate on the house than it will be on a credit card generally, and it's tax deductible most of the time.
Mm-hmm.
That works so long as you just don't run up the credit cards again.
Oh, yeah.
So you have that issue.
Credit cards. That's
Right. If you
really
kill the credit cards and you do that, it's a good strategy. But if somehow that frees up the credit cards and allows you to re-borrow and whatnot, sometimes we recommend that people don't do it, depending on their personality. So there is a little bit of a behavioral personality
Right.
issue that you do
Case
have
by
to consider.
case.
It is case by case.
Yeah.
But generally it's a good idea.
Gary, you want to add anything
Yeah, I
to that
think,
before we move along?
Yeah, just from an investment standpoint this year, a little bit different. The last couple of years have been the years to be in the United States, and we still think that's the case, as opposed to in international investments. We're starting to more look into the international now, because we feel that they're starting to stimulate in Europe, it's, for example, on their monetary policy, and start to build and get out of their recessionary situation. We think that presents some opportunities. So again, the last couple of years, really the U.S. has been by far the strongest place to be, and we do think that'll be continue to be the place this year. International is an area that we're looking at.
No need to move to Switzerland.
Well, unless you like the chocolate or the skiing.
Leave it to you to bring up the chocolate and the skiing. See, Gary and I are just,
I know.
we're just talking about the base. So let's move along. Divorce. It's a really hard topic to talk about for a lot of people. Not me, of course. No, I'm good with it. But I know that's one of the things that you gentlemen have begun to address with a number of clients. And so let's spend some time giving some people some advice about that. I mean, the first thing, obviously you try to save your marriage, and when you realize you can't, and at that point, we're just going to talk about the specifics once you've decided on divorce. First thing you got to do is get some professional help.
I think that's a very good point. The first thing, a lot of people, when they think of professional help, obviously think of attorneys. And that's usually the first person that you consult with if your marriage, like you said, has disintegrated. I think a lot of people just don't do a lot of pre-planning before the divorce, and that's really one of the major issues to think about.
I think people aren't really thinking they're going to get divorced.
Right, but if you've decided maybe that you think you're going to get divorced,
then what do you do?
I think you need to start to talk to a financial advisor, so that sometimes one of the parties may not be left in a situation where they're prepared to actually go through a divorce. So,
what do you mean?
Well, as an example, if you know, husband and wife, and let's just say the wife has all the money in her checking account and the husband wants to get divorced and they decide to separate, the husband may not have any money to actually move through a divorce. So you actually have to have money to get divorced. You just cannot get up and leave and get divorced. You have to have money to get a new house or rent a place. You have to have money to file. You have to have money to pay the divorce attorney. And a lot of times, both spouses actually don't have money in their own accounts. It may be in just the other spouse's account. You have to sort of prepare and make sure there's enough money in the person who's leaving and who's initiating the divorce's account.
So what I hear you saying is that if you have come to the point in your life where you realize a divorce is inevitable, the very first thing to do is to talk to a financial expert, even before a divorce attorney?
I think it can be helpful to make sure that you're prepared for all of the financial consequences of actually going through the divorce process, not even post-divorce, because obviously the divorce courts and judges sort of work that, but the process can last a year, 2 years, 3 years, depending on your situation. And you have to be prepared during that period. And it can be traumatic for someone when they realize that they don't have enough money to work the process until a judge can figure out how to divide assets and do stuff. I find that actually one of the most difficult pieces that people overlook. And while it's not really a technical issue per se, it's something to really, really think about.
There are a lot of good divorce attorneys, and I know many of you watching are divorce attorneys. And a good divorce attorney obviously will help a client through a lot of that. But this is even before that, is what I hear you saying.
I think so. I think, if, like you said, if you're contemplating it may be an issue a year in the future, or 6 months in the future, or it's inevitable, to really start to think about your own financial plan. How are you going to work the process? What are you going to do after? A good financial advisor can give you some sense of probably what you could expect to receive in a divorce, because, as you know, in divorces, or what have left over, there are rules in Massachusetts, for example, for child support. It's not a mystery for how much someone will have to pay for child support.
There's a formula.
There's a formula, a very specific formula. Even alimony, there's a fairly specific formula.
Laws have changed, though, recently, haven't they?
They have, to probably make alimony a little bit more formulaic than...
equitable, is that a word that would...
It could be. I mean, I think it's given some rules, so there is some idea of what the alimony calculation will be. It used to be that the judges would have a lot of discretion, and it's really removed some discretion from the judges. But, depending how long your marriage has been intact, there are rules as to what assets will be divided.
Gary, jumped in here.
Well, I think as Mike said, the pre-divorce as well as the post-divorce planning is something that we spend a lot of time on in terms of our understanding of the budgets, there can be a lot of moving parts. You might have kids going off to college. I mean, just so many different, one spouse might work full-time, the other one may not work full-time. I mean, you have all kinds of different scenarios. So what we try to do is to work very hard to pull together the pieces of the puzzle and actually put them down on paper as a budget. So we have the software systems that we use to pull that information all together. So as Mike said, on the asset side, that you know where the accounts are and where you have available funds, but you also have because it's obviously a very traumatic sort of, there's a lot of angst going on, have at least a sense that, okay, I can see what my monthly budget is. Do I have to make some changes, et cetera. So that's a part of as I said, the pre-divorce period, but also post-divorce, having all of that down on paper and, run different scenarios.
Is one gender more susceptible through statistics than another? In other words, do women need to know certain things that men, don't need to? Is it different?
There's probably a slight tendency towards women having less control over their finances, not so much less knowledge, but generally a little bit less control. In that, I think there still is a percentage more men who are the primary wage earners than women, especially when they're raising children. And the primary wage earner generally pays the bills. It depends. It's not always true. So most definitely, if you're a woman, raising children and stuff like that, it's even more paramount that you sort of, take a look at this early on. And sometimes for more senior divorces, that can be an issue as well for either party.
Well, I think one of the things that you said that's very encouraging to a lot of people is that the laws have changed so that the judges are not the ones who are arbitrarily making decisions based on what they think might be fair and equitable. Absolutely.
I think it is good to have rules because you get more stability. Whether all the rules are completely fair, it's sort of a legislature, a issue or lawmaker, but the rules seem to be reasonably equitable and fair in my humble opinion. The issue is trying to figure out who has what assets, what income there really is.
And honesty is really important.
It is.
You really have to, one of the first things is filing the financials.
Right.
And knowing how to do that sometimes can even be overwhelming. Lawyers can help you through it, but what I hear you saying is that you need to have a good financial person.
Right, and you know, you have a lot of assets that you may not have a specific value, real estate or other, or companies or businesses. It's hard to value those things, so it's important up front for a person to get an idea of, if you're in a family business, what that actually might be worth, as opposed to speculating or having some fantasy as to what you think you might get in a divorce. You might enter a divorce thinking you might get a certain amount of assets, when in fact, by the time things are valued and done, you may not, and it may not be as beneficial of a result.
Mm. Now, you guys obviously are not divorce attorneys, nor do you want to be. This is not about trying to dissolve marriages, but what it is about is trying to make sure that people are protected and understand their rights and what they have.
Yeah, it's all about going into it with eyes wide open and just understanding, and I think it relieves the pressure, it relieves the stress, and just helps through what, as Gary mentioned, as we all know, is just a very traumatic process in and of itself. It's tough enough to go through the legal process. If we take this issue off the table and have a little bit more knowledge and plan, almost a divorce financial plan that we sort of recommend you go into the divorce with a little bit of a financial plan, it takes the pressure off.
Yeah, and there are tax ramifications and all those things that people just don't even think about.
Oh. Divorce is probably the most complicated financial planning issue that there is. It honestly is in so many ways. So you have to really take it that seriously, that it's going to be that serious to you currently and sometime in the future. And the tax issues, the insurance issues, the estate planning issues, the educational and issues, it's just endless.
Children, it's endless.
Endless. It is endless.
Unfortunately, this show is not endless. And we have to. Is there anything else quickly in our last minute that you want to touch on? Gary, anything you want to add?
I just think in terms of divorce, so I guess the bottom line is that it's a team effort. It's not just the attorney, but it's whether it's an accountant or financial advisor, investment, or all of the above.
Yeah.
To be involved. And number two, not necessarily wait too long, but have it be part of the pre-divorce process as well as post-divorce.
I guess that's the one message that we really want to send to everybody, that you really need to have a good financial expert in your life for whatever reason. I mean, just an advisor.
Yeah, there's nothing wrong with having someone just to bounce off questions and to support you at any phase of your life. It's probably a good idea.
I would say.
Right, people are very busy today, so to have that extra team member is comforting as well as helpful.
Right, and a lot of us are not the financial experts that we would like to be. That would be an understatement in the case of moi. So thank you very much,
No, thank
Gary
you.
Kuhn,
Thank you,
Michael
Susan.
Feiner from Feiner Wealth Management. I'm Susan Warnick. See you next time.